The phone calls started coming in Tuesday afternoon. Dealers across the country, some who've been in this business for 30 years, calling each other with the same message: we're out, completely out. Not low inventory, not waiting on shipments, out. The supply of physical silver just ran dry, and what's happening right now in the precious metals market is something most people won't understand until it's too late. Let me paint you a picture of what's actually going on behind the scenes. The US Mint stopped accepting orders for Silver Eagles. Just stopped. No warning, no gradual slowdown, just a hard stop on new orders. Now, if you've been following precious metals for any length of time, you know the Mint occasionally has production issues. But this isn't a production issue. This is a supply crisis that's been building for 5 consecutive years, and we've finally hit the breaking point. The Silver Institute has been tracking this for years. 5 straight years of supply deficits. Think about what that means. For 5 years running, the world has consumed more silver than it's produced. Every single year, we've been drawing down existing stockpiles, draining the reserves, eating into the buffer that's supposed to protect against exactly this kind of situation. And now, the buffer's gone. Here's what makes this different from every other supply squeeze you've heard about. This isn't speculation. This isn't some conspiracy theory about market manipulation. This is basic arithmetic. Industrial demand for silver has exploded. Solar panels alone are consuming silver at rates that would have seemed impossible a decade ago. Every solar panel requires silver paste for the photovoltaic cells. As the world races toward renewable energy, as countries commit to net zero targets, as solar installations multiply across rooftops and fields, the industrial consumption of silver keeps climbing. But it's not just solar. Electric vehicles need silver. 5G infrastructure needs silver. Medical devices need silver. The electronics in your phone, your computer, your car's dashboard, they all need silver. And unlike gold, which mostly sits in vaults after it's refined, silver gets used up. It gets consumed in industrial processes. It doesn't come back into the market. Once it's in a solar panel on a roof in California or a circuit board in a smartphone, it's effectively gone from the available supply. Now, before we go further, I want to mention something quickly. If you're watching this and you're concerned about protecting your wealth in this environment, I put together a free guide that shows the saving secrets thousands of American retirees are using to protect their hard-earned wealth. It's in the description below. Just something to check out if this resonates with you. So we've got this massive industrial demand that keeps growing, and on the other side of the equation, we've got mine production that's basically flat. Silver isn't typically mined on its own. Most silver comes as a byproduct of copper, lead, and zinc mining. So when copper prices don't justify opening new mines, we don't get new silver supply either. The primary silver mines that do exist are facing the same challenges every mining operation faces: rising energy costs, stricter environmental regulations, longer permitting times, deeper ore bodies that are more expensive to extract. The math doesn't work anymore. We're consuming more than we're producing, and that gap is widening. The Silver Institute's projections show this continuing, not for 1 more year, not for 2. This is the new normal until something fundamental changes in either supply or demand. And right now, I don't see either one changing in a direction that solves this problem. Let me tell you what happened to a dealer I know in Texas. He's been in business since the 90s, survived every market cycle you can think of. He told me that last week, he had customers coming in with cash, ready to buy, and he had to turn them away. Not because he didn't want their business, because he literally had nothing to sell them. His distributors are back-ordered for weeks. The premiums on what little physical silver is available have gone through the roof. We're talking premiums that would have seemed absurd 6 months ago. And here's where it gets really interesting. Look at what's happening in the paper market versus the physical market. Silver is trading on the COMEX, the futures exchange, and those prices are based on contracts, on paper promises of silver. But when you try to actually take delivery of physical silver, when you try to convert those paper contracts into real metal you can hold in your hand, that's where the system is breaking down. The spread between paper silver and physical silver keeps widening. The premium you pay for a physical coin or bar over the spot price keeps climbing. What does that tell you? It tells you the paper market and the physical market are starting to disconnect. It tells you there's a lot more paper silver being traded than there is actual physical silver available to back it up. And when that disconnect gets wide enough, when enough people start demanding physical delivery instead of just trading contracts, that's when the real price discovery happens. Think about what happened with nickel a few years back. The London Metal Exchange had to halt trading because the price went parabolic when people actually tried to take delivery. The paper market couldn't handle the physical demand. Now, I'm not saying silver is going to have that exact same scenario, but the dynamics are similar. When paper promises meet physical reality, price has to adjust to reflect actual scarcity. Central banks understand this. They've been accumulating gold at record rates, but smart money is also looking at silver. Why? Because silver has this unique dual nature. It's a monetary metal with thousands of years of history as money, and it's an industrial metal that's absolutely critical for modern technology. That combination creates a situation where demand comes from multiple directions at once. You've got investors buying silver as a hedge against inflation, against currency debasement, against the kind of monetary chaos we're seeing with trillion-dollar deficits and central banks that can't seem to stop printing money. And at the same time, you've got industrial users who need silver for production, who can't just decide not to buy it because the price went up. If you're manufacturing solar panels or electric vehicles, you need silver. There's no substitute that works as well. You pay the price or you stop production. This creates what's called inelastic demand. When demand is inelastic, price increases don't reduce consumption by much. People and companies keep buying because they have to. And when you combine inelastic demand with constrained supply, you get explosive price movements. Let me take you back to a moment in history that rhymes with what we're seeing now. In the late 70s, silver went from around $5 an ounce to $50 an ounce in a matter of months. Now, that was driven partly by the Hunt brothers trying to corner the market, which is a whole other story. But underneath that speculation was a real supply-demand imbalance. Industrial demand was growing, mine supply wasn't keeping up, and investors were fleeing inflation and a weakening dollar. Sound familiar? We've got the same fundamental setup today, except the industrial demand is even stronger because of all the new technologies that didn't exist in the 70s. We didn't have solar panels and electric vehicles and 5G networks consuming silver back then. The industrial demand today is structural, not cyclical. It's not going away when the economy slows down. If anything, the push for green energy accelerates during economic uncertainty as governments try to stimulate through infrastructure spending. Here's what keeps me up at night. The COMEX, the exchange where silver futures trade, has a certain amount of physical silver in its registered vaults. That's silver that's available for delivery against futures contracts. The ratio of paper contracts to physical silver in those vaults has been climbing. At some point, if enough contract holders decide they want physical delivery, instead of just rolling their contracts forward, the exchange could face a serious problem. We saw a glimpse of this a few years ago when the retail silver squeeze happened. Remember that? Retail investors coordinated buying of physical silver and certain silver ETFs, trying to force a short squeeze. The price spiked, premiums went crazy, and dealers ran out of inventory. The establishment dismissed it as a temporary frenzy, said the market would normalize. And it did, for a while. But here's the thing. That was retail investors, mostly small buyers, and they still managed to disrupt the market significantly. What happens when institutional money decides to make the same move? What happens when a sovereign wealth fund or a major hedge fund decides they want physical silver instead of paper exposure? What happens when pension funds start allocating to physical precious metals as a portfolio hedge? The market isn't set up to handle that kind of demand for physical delivery. The infrastructure doesn't exist. The refining capacity doesn't exist. The logistics don't exist. I talked to a refiner recently who told me they're running at full capacity and still can't keep up with orders. They're working overtime, they've hired more staff, and they still have a backlog that stretches for weeks. This is a refiner who's been in business for decades. They've seen market cycles. They've seen demand spikes. They told me this is different. This isn't a spike. This is a sustained elevated demand that shows no signs of letting up. And here's the kicker. A lot of the silver that does get refined is already spoken for. It's going to industrial users who have long-term supply contracts. It's not available for the retail market. It's not available for investors. So the silver that is available for investment is an even smaller slice of total production than the numbers might suggest. Let's talk about what this means for price. Silver has historically traded at a gold to silver ratio that averages somewhere around 50 to 1 or 60 to 1 over the long term. Right now, even with silver's recent gains, that ratio is still above its historical average. If silver were to revert to its historical relationship with gold, and gold is trading where it is now, silver would need to move significantly higher just to reach that historical norm. But here's why I think it could go even further than that. The historical ratio was established in eras when silver's industrial demand was a fraction of what it is today. The ratio was based primarily on silver's monetary role and its relative scarcity compared to gold. Today, silver has this massive industrial demand component that didn't exist historically. That should theoretically support a lower gold to silver ratio, meaning silver should be worth more relative to gold than it was in the past. If you're sitting on retirement accounts, if you've built up savings over decades of work, this is the kind of environment where you need to think seriously about diversification into hard assets. I'm not talking about speculation. I'm talking about wealth preservation. When you've got supply deficits, when you've got dealers running out of inventory, when you've got the US Mint stopping orders, these are signals that the market is under stress. Quick aside here, and this is important. If you're sitting on $100,000 or more in retirement accounts, I put together a comprehensive guide on how gold IRAs work. It's in the description. It covers how you can get physical precious metals into your retirement account without tax penalties, how the process works, what the rules are. This isn't about making a quick buck. This is about protecting what you've already built from the kind of monetary instability and market chaos we're seeing accelerate. Worth checking out if you're in that situation. Now back to what's happening in the market right now. The dealers who are out of stock, they're not just out of silver eagles. They're out of everything. Rounds, bars, junk silver, it's all gone or severely limited. And when they do get shipments, they're selling out within hours. This isn't normal market behavior. This is panic buying meeting supply constraints. And it's not just in the United States. This is global. Dealers in Europe are reporting the same thing. Dealers in Asia are reporting the same thing. The physical silver market is tight everywhere. When you have a global supply crunch in a commodity that's critical for industrial production and also serves as a monetary hedge, you have the ingredients for a serious price dislocation. Let me tell you what I think is going to happen next. And I want to be clear, this is analysis based on supply and demand fundamentals, not financial advice. I think we're going to see continued upward pressure on silver prices as the physical shortage becomes more widely recognized. I think premiums on physical silver are going to stay elevated or go higher as dealers struggle to source inventory. I think the spread between paper silver and physical silver is going to widen further. And I think at some point we're going to see a moment where the paper market has to reconcile with physical reality. That could come in the form of a short squeeze on the COMEX. It could come in the form of a major ETF having trouble sourcing physical silver to back new shares. It could come in the form of an industrial user publicly stating they're having trouble securing supply. However it manifests, when that moment comes, the price adjustment is going to be swift and significant. Here's what most people don't understand about precious metals markets. They're relatively small compared to other financial markets. The entire silver market, all the silver that trades in a year, is tiny compared to the bond market, or the stock market, or even the oil market. That means it doesn't take massive amounts of capital to move the price significantly. When you have a supply shortage in a small market, and you have even a modest increase in investment demand on top of already strong industrial demand, the price can move very quickly. We've seen this play out before in other commodities. When there's a genuine supply shortage, not just a temporary disruption, but a structural deficit, prices don't just drift higher gradually. They spike, they gap up. They move in ways that catch people off guard, and the people who get caught off guard are the ones who waited, who thought they had more time, who didn't take the warning signs seriously. The warning signs are flashing red right now. The US Mint stopping orders is a red flag. Dealers being out of stock is a red flag. 5 consecutive years of supply deficits is a red flag. Rising premiums on physical metal is a red flag. The widening spread between paper and physical is a red flag. How many red flags do you need to see before you take action? I'm not saying you should panic. I'm not saying you should make emotional decisions. I'm saying you should look at the facts, understand what's happening in the market, and make informed decisions about how to protect your wealth. Because here's the reality. When the supply runs dry, when dealers have nothing to sell, it doesn't matter what the paper price says. You can't buy what doesn't exist. And that's the situation we're approaching. We're not there yet completely, but we're getting close. The physical market is showing severe stress. The supply chain is stretched to the breaking point, and the demand from both industrial users and investors shows no signs of slowing down. Think about the geopolitical situation too. We've got tensions between major powers at levels we haven't seen in decades. We've got countries actively working to reduce their dependence on the US dollar. We've got central banks around the world diversifying their reserves. We've got trade wars and tariffs and supply chain disruptions. All of this creates uncertainty, and uncertainty drives people toward hard assets. Silver, along with gold, has been money for thousands of years. It's been a store of value through empires rising and falling, through currencies being debased and replaced, through wars and depressions, and every kind of economic chaos you can imagine. There's a reason for that. There's a reason people turn to precious metals when they lose faith in paper currencies and government promises. And right now, we're in an environment where faith in institutions is declining. Faith in the stability of the financial system is declining. Faith in the purchasing power of fiat currencies is declining. People see inflation eating away at their savings. They see government debt spiraling out of control. They see central banks trapped between fighting inflation and preventing economic collapse, and they're looking for alternatives. Silver offers something unique in this environment. It's affordable enough that regular people can accumulate it. Unlike gold, which is expensive per ounce, silver allows you to build a position gradually. You can buy a few ounces at a time. You can dollar cost average into a position. And because of the supply situation we've been discussing, because of the industrial demand dynamics, silver has significant upside potential. But here's the critical point. That upside potential only matters if you can actually acquire the physical metal. If dealers are out of stock, if premiums are through the roof, if delivery times stretch to months, then the theoretical upside doesn't help you. You need to be positioned before the crisis becomes obvious to everyone. That's the nature of these situations. By the time it's obvious to everyone, by the time it's on the front page of every financial publication, by the time your neighbor is talking about it, it's too late to get in at reasonable prices. The people who benefit are the ones who saw it coming, who understood the fundamentals, who took action when others were still skeptical. I've been studying precious metals markets for years. I've seen cycles come and go. I've seen bull markets and bear markets. I've seen manipulation and squeezes and everything in between. And I'm telling you, what's happening right now with silver is different. This isn't a normal cycle. This is a structural supply deficit meeting unprecedented industrial demand in an environment of monetary instability and geopolitical chaos. The confluence of factors we're seeing doesn't come along often. When it does, it creates opportunities for people who are paying attention and willing to act. But it also creates risks for people who ignore the warning signs and assume everything will just continue as normal. Let me give you another historical parallel. In the early 2000s, there was a uranium supply deficit. Utilities needed uranium for nuclear power plants, but mine production had been declining for years. Inventories were being drawn down. And then, as the deficit became more widely recognized, the price of uranium went from around $7 per pound to over $130 per pound in a few years. The people who understood the supply-demand dynamics early made fortunes. The people who waited until it was obvious paid peak prices. Silver isn't uranium. The markets are different, the uses are different, the dynamics are different, but the principle is the same. When you have a genuine supply deficit in a commodity that people need, price has to rise to either stimulate new supply or ration demand. And in silver's case, new supply can't come online quickly. It takes years to develop new mines. It takes years to expand refining capacity. The supply response is slow, but the demand is here now. So what do you do with this information? First, educate yourself. Understand what's happening. Don't just take my word for it. Look at the data. Look at the Silver Institute's reports. Look at what dealers are saying. Look at the premiums. Look at the COMEX inventory levels. Do your own research and come to your own conclusions. Second, If you decide that physical silver makes sense for your situation, act sooner rather than later. Don't wait for the perfect moment. Don't wait for a pullback that might not come. Don't wait until dealers are completely out of stock and premiums are double what they are now. If the fundamentals make sense to you, if you understand the supply situation, if you see the same warning signs I'm seeing, then make a decision and execute it. Third, think long term. This isn't about trading. This isn't about trying to flip silver for a quick profit. This is about wealth preservation. This is about having a portion of your wealth in something tangible, something that can't be printed, something that has intrinsic value. Whether silver goes up next month or next year is less important than having it as part of a diversified strategy to protect your wealth over the long term. And finally, stay informed. This situation is evolving. The supply deficit is real, but how it plays out, how quickly it plays out, what triggers the next major move, these are things we'll learn as events unfold. Stay connected to reliable sources of information. Watch what's happening in the physical market, not just the paper price. Pay attention to what dealers are saying, what industrial users are saying, what the data is showing. For those of you who've watched this far, who've stuck with me through this deep dive into the silver market, I want to offer you something special. That guide I mentioned earlier, the one about protecting your wealth, if you check the description and reach out, you'll get access to an exclusive one-on-one educational web conference. No obligation, just education. But here's the thing, this is only available to American retirees with at least $100,000 in retirement accounts. And you need to mention you watch this video to the end. This isn't for everyone. This is for people who are serious about understanding their options, about protecting what they've built over a lifetime of work. The supply of silver just ran dry. Dealers are out of stock. The U.S. Mint stopped taking orders. 5 years of supply deficits have finally caught up with the market. Industrial demand keeps climbing. Investment demand is accelerating. The paper market and the physical market are disconnecting. All the pieces are in place for a significant price move. The question isn't whether this is happening. The question is what you're going to do about it. Are you going to wait and see, hoping it all works out, hoping supply magically appears, hoping the deficit resolves itself? Or are you going to look at the facts, understand the implications, and take action to protect your wealth while you still can? Because here's the truth that nobody wants to say out loud. When the supply runs dry, when there's nothing left to buy, the price becomes irrelevant. You can't buy what doesn't exist. And we're approaching that point faster than most people realize. The dealers know it, the refiners know it, the industrial users know it, the smart money knows it. The only question is, do you know it? And more importantly, are you going to do something about it before it's too late?